Hey, this is Jeff. Welcome back to the Small Business Valuation Essentials training course. In this video, we're going to talk about adjusting the multiple you found to better fit the subject business. So where we are in the process is towards the end, once we've already found the cash flow and we've done the comparable sales research. Now we're trying to put the two together, but we want to adjust the multiple to better fit our business. So this is a slide that we used in the last presentation, and I wanted to go over it again to talk about the limitations of comparable sales data. So when you pull information from peer comps or from BVR or BizMiner, you're going to get a limited look into the sale. And part of that is because they don't want to identify the business that's being sold, and part of that is there's just limited information submitted by brokers. So when you get a comp, you're getting the sales price, the revenue, the earnings, profit margin, the multiple, the state that the sale occurred in the year, and the value of the equipment at book value typically. But when you think about it, that's really not all that much information on a business. You know, if that was a house and you listed out that much detail, it would be a pretty good amount of information. But because of the confidential nature of businesses, it makes it really difficult to ascertain whether it was a business that would pull a higher multiple than another business, or were there other factors that affected the sale. There's really not that level of detail in the comps. BVR has the best comps when it comes to the amount of data that you get by far. Sometimes the business is even identified, but for the sake of this video, we're going to talk about more Main Street and lower middle market comps that come from something like peer comps. So the reason that this becomes an issue is when you think about taking an average or looking at comparables, there are so many factors that affect the value of a business. And I just listed out a couple here to give you things to think about. The business's location. So if it is in a rural area, probably going to be a little bit lower than a metro area. The stability of the cash flows. So, even if the business made the same amount as another this year, what did the previous years look like? We typically don't get that data. Are there any growth opportunities for that particular business or the area that it's in? Does the company have a unique skill set that other comps might not have? The employees are a large part of what you're buying, and not having any information on their experience or their tenure is really important. The value of the equipment. So I touched on this in the last slide and in previous videos. The value of the equipment provided in the comps is typically at the net book value. That's usually not a very useful measure because the value of the equipment could be much higher or much lower than what you see in the comp. So we'll see that on one of the future slides, and I'll point it out just how important this is. The branding, reputation, and positioning of the companies. One company could be a franchise. One company could have really great branding as a small business and be well known in the community. If that's the case, those businesses are going to have a pretty different value. And then lastly, information asymmetry. So because we don't have the same information as the broker who originally priced the deal or the buyer and seller, there's tons of stuff that we're not going to be able to understand. One of those is, was the transaction at arm's length? So a lot of the deals that you'll see in databases, I don't know how many, but certainly a pretty good number of them are not sales that happened at arm's length. So they could be selling to another family member, to the manager, to an employee, to somebody who already lives in the community and knows the business. So these are just a couple things to think about why you can't directly apply comps in all situations. So the question that you might ask then is, will I have to adjust the multiple every time? And the answer to that is no. Not every time will you have to make an adjustment plus or minus to what you get from the database. For example, if you're valuing a landscaping business, this industry typically has a lot of sales. There are a large number of them, and you can typically find a good number in the same state around the same cash flow. If that's the case, oftentimes you can just use the method I described in the previous video, where you take the average of 10, 15, or 20 comparables, and then you do maybe plus or minus one standard deviation of that set. That'll usually give you a range that's broad enough to get most of the potential sale prices for that business, but also narrow enough that it's useful for the owner and useful for you as a broker or an advisor. But in a lot of cases, you will have to adjust the multiple. And so we'll touch on how to estimate what you might need to adjust, and then also some common reasons for adjusting it. So real quick, just touching on, this is some data from the previous presentation that we did. This is a couple tour companies' data that I pulled from Pure Comps for a real valuation we did at MidStreet. And I wanted to just give you guys a couple things that I would look at immediately when pulling comps to start to think about why you might need to adjust. So for reference, this was for a valuation that we did on a tour business. And so that's an industry where you're going to have trouble finding comparables because there are a few of them and they're going to vary a lot between companies. So when you compare this to maybe a gas station where the product or service is pretty clearly defined, a tour business might include everything from, well, going to this list, NASCAR race event packages to snowmobile tours to marine tours, scenic and sightseeing tours, outdoor adventures, charter buses. So it covers so many different things that it's not going to be possible to use this data without adjusting it. And then also, because there are so few, we had to open up the range to tons of different sizes of businesses. When you put this on a scatter plot, you can kind of see how the smaller the size of the business affects the multiple, which is usually the largest adjustment you'll have to make, because the price of most small businesses is driven largely off of cash flow. You'll start to see that businesses with lower cash flow tend to be worth less in the same industry. So we can kind of start to see this, but this is a good example of why you need to adjust comps. This business here, if you didn't remove it or adjust it, would be a poor comparable because it's in an industry that's not the same necessarily as the other ones that we pulled. So I would probably eliminate this comparable, and we talked about that in the last video. This is not a good comp. But when you remove that, you can start to see that the average of these might not be the best place because these businesses are much smaller, and our business is over here. So that's exactly what we did in the last video. We took the average, which was 3.36, and increased it to 3.6, and then applied the one standard deviation plus or minus to get a range of 3.2 to 4 for our multiple. And then you can see down here where we applied that and found the range of values to use in the presentation. So what are some of the common adjustments that need to be made that will raise the multiple, raise that average multiple? If the earnings of the business are higher or lower than the comps, if the sales occurred in a different market, so if the market is hot or slow, you would know this if you're in, for instance, we're in Raleigh, and Raleigh is one of the fastest growing metro areas in the country. When we sell a business in Raleigh, it typically carries a premium over a business in one of the more rural parts of North Carolina. If there's consolidation occurring in the marketplace, so we sold a stone supplied distribution company. It was a landscaping distribution company. That business had a very high multiple compared to what it would have a couple years ago because there is significant consolidation and private equity play in that industry. If the business you're valuing is owner absentee, that's usually a pretty good adjustment because the new owner coming in will be able to focus on growing the business or truly operate it passively. If the business has experienced above average growth for a couple years, that's usually an indication you'll want to raise the multiple. It looks like, okay, so I misspoke on the first one. If this one is about if the business is in a highly desirable market area, the one above was referring to the market conditions. So if the sales occurred in a different part of the economic cycle, for instance, right now it's middle of 2022, interest rates are going up. There's a lot of uncertainty in the market. That probably we'll see reflected in the Q3 data here soon that the average multiples are starting to come down a little bit. And then finally, if the business has guaranteed growth opportunities, this is not something where the seller says, hey, I want, I'm going to implement this, we might see growth. This would be, hey, we just signed a really big contract for next year, or that's going to be for the next 3 years, or we have a backlog of 6 months of work. Those things will definitely increase the multiple. Then some things that will adjust the multiple down. If the business is highly disorganized, that's one. If the business has had declining revenues or earnings for multiple years, especially if it's been 3 or 4 years, that will certainly hurt the multiple. If the business is in an undesirable market area, so not just kind of your normal smaller metro area, if you're using comparables, for instance, from the continental US for a business in Alaska, it's probably not the right way to do it. If the business has a customer concentration issue, so I think this can be defined as any one customer making up more than 20% of revenue, you'll want to adjust the multiple for that. And if the business has any known need for immediate capex, so if the business has equipment that's out of date and will need to be replaced, that needs to be factored into the value. And finally, if the business has significant financial errors that had to be corrected, or books that are just so messy it's hard to understand, that typically will be a significant impairment on the value. So then I guess one last thing to note here that I should have included in the slides. In this course, we're talking about valuing a 100% controlling interest in whatever company we're valuing. So because of that, one adjustment that would need to be made for some businesses would be a discount for a lack of control. We typically don't do that in our valuations. We tend to just value 100% and then let the owner decide how they would like to treat that. But for the purposes, or for your purposes, just understand that you would need, if you were valuing, say, an 80% or 90% ownership interest, there would be a slight discount to that. And then if it was obviously a minority interest in the business, it would be significant discount. So hopefully this gives you some ideas to think about when you're adjusting multiples. I will say this is one of the more tricky parts of valuation. It really comes down to understanding the marketplace, understanding the sales of other businesses and looking at the comps. You'll get a good feel for it over time, but at the beginning it can be a little bit confusing, the way that everything seems arbitrary. If you have any questions, feel free to reach out to me. My email is Jeff Jr., that's Jeff, Jr. @midstreet.com. I will say the next video is also very useful for helping you get a good feel for this. In that video, we're going to talk about the buyer test method, which is a way that you can sanity check the value you arrive at through a SBA 7A loan scenario. So look forward to that video. And again, if you have any questions, feel free to post them down below. Thanks for watching and look forward to seeing you in the next video.